Hello and welcome to the Investing Master Series. My name is James Boyd. Alongside me, my good friend Barbara Armstrong in the chat. You know Barbara, say hello to Barbara. And hello to all of you. We got Jameis Scott, WW, Dom, Honey, 2, Scott Luck, Aloha, Bill, back to you, Scott, Bill, and many others. Good morning and welcome to all. Boy, exciting times. We're going to talk about some of the things in the market that are kind of at extreme levels, and we'll show that here in just a moment, which is kind of exciting. Now, also just real quick, Olga, we welcome you. Paul, hello to you. Now, just real quick, you can follow Barbara and myself on X. There's our handles. We post educational content there daily. And also it gives you some announcements and educational examples. Quick reminder that with what we discuss, we'll talk about stocks. We will also talk about options. Remember that options carry a high level risk and are not suitable for all investors. When we talk about the information, it's done for general informational purposes only. Our examples will be done in the Paid Money software application. Also remember that investing involves risk. And when we talk about examples, they are just that. Also understand when we talk about short options. So today we're going to talk about short puts or cash secured puts as trades. There's three different, well, I'll just keep it at this. When we talk about American style options, which is what we talk about. If we sell a put, those could be assigned to buy the shares at any time up to the expiration, regardless of the in the money amount. Okay, so that means we could buy those shares of stock at the strike price, even though it's not an expiration. And so we just need to understand that. And is that okay? Now that should also bring into, the question is, would you mind in buying those shares prior to expiration? So that's a very good question to ask ahead of time. When we also talk about examples, we're going to demonstrate analysis and also trading functionality. Now, I want to kind of take a look at the market conditions. And what I want to do is kind of show some extreme things that we're seeing right now. And I was kind of looking at this. I don't know if I've ever seen it the way that it is right now. Back in 07 to 08, oil went to 147. And when you look at the price of oil, we're going to use the ticker symbol /CL. That's light sweet crude. Now, when you look at a product like this, you're actually looking at a certain expiration. And what's very interesting, we know that oil's been up. Okay, we get it. Okay, but what the thing I want to kind of point out as stock and option traders is kind of the relationship that we're kind of seeing between the crude oil price, which clearly has been going up, but at the same time on the bottom, what's been interesting is if we're looking at the energy sector, as oil has gone up, we've seen the pressure kind of happen a little bit to the downside where the IXE has struggled to follow pace, okay? So what does this really mean? Well, IXE is a group of, it's an index. We're tracking the index. If you have a different ticker symbol that is tracking stocks, which you probably do, you don't need to use IXE, okay? I'm using IXE because this is not the ETF class. But if you look at this, if we use a different product that was not an index, but literally was a basket of stocks, it is interesting to note that as oil has gone up higher and higher, we're actually seeing kind of that negative correlation here. Continue to watch that, okay? Now, you got to remember is when you look at, let's say, energy stocks, if someone were to buy the basket, that basket of stocks is also correlated to the stock market. And so as energy prices go up, it can actually push down and has been pushing down the market. That's not a news flash, okay? We know that. But I think the biggest actually thing is we're starting to see the breakdown in energy stocks not really going up in line with actually crude oil. Now, why do I just go over all that? Now, the one thing to kind of take notice of, why I kind of said this is a little historic what we're seeing right now, is with each one of these months, May, June, July, August, September, you're going to see that there's a lot of pressure in the May. In other words, we need the product. We need the product. We need the product. We're fearful that we're not going to have the product and so on. And so the price is like a balloon, right, for the next 14 days. But what's interesting is when you look at this going into, let's say, June, July, August, September, we're talking about July, say summertime, September, $80 to $90 price point there. So this is why some people are talking about short oil. This is why some people, for example, are talking about long airlines. Now, I don't know if I've ever seen such a spread between the current month and the backdated month. We're talking about a spread of $37. This matches what we saw in 07, 08, where oil went to 147 and collapsed. Okay. Now, there's fear back then too. So the biggest thing is keep an eye on that. Okay. Now, by the way, oil, what the price of oil is, obviously has a correlation to the stock market, has a correlation to, let's say, retail stocks, airlines, discretionary names, and so on. So many ideas come from really crude oil. Clearly tonight, the 8 p.m. Eastern deadline, we'll see how that plays out. I'm not sure if anyone knows how that's going to play out, but clearly some investors are seeing some short-term pressure, clearly. And we see that in the price. Now, real quick, if we pull up the SPX is kind of holding in there for the most part. I mean, we're down, let's say 74, down 1%, not taking out the 20-period moving average, but clearly would like a green candle here, okay? But is it reversing? I don't know if we can say that, okay? But getting down below the 10. So some of that momentum is coming off. Dow Jones itself, here we are sitting at the 465. Liked it better this morning when it opened up a little higher. But again, there's a lot of people are posturing for what might happen tonight. Russell, if you look at the Russell, guy, you'd actually have to say the Russell, yeah, it's down, but it's kind of holding up closer to the resistance line, and the NASDAQ itself kind of right there. Clearly, the NASDAQ still being the struggle area. And if you look at the semiconductors, actually holding up fairly decent, okay? So semiconductors and Russell got it fairly strong, okay? Now, could we actually see a lot more in the next day or so? Oh, sure, okay? But I think the biggest thing is when we kind of talk about the oil prices at where they are, the word that we might use is unsustainable, okay? Now, we know that when you talk about, let's say, the calculations for inflation, how convenient that it does not include energy or rent. I mean, how convenient is that, okay? So the biggest actually thing is, I'm just going to use the word, unsustainable, okay? I mean, if we kind of said going forward in that summer months, $80 to $90, we could probably see that because there's probably going to be a premium to some of the things that are happening. Sure, but having that price stay there where it is, we're going to use the word unsustainable. Could it go up higher in the short term? Sure, but intermediate term, weeks to months, we're going to use the word unsustainable. Okay. Now, if we take a look at this, I want to kind of talk about just real quick the topic of short puts as a trade. Okay. Now, what I want to do is I want to kind of take a look at, let's say, a stock example given. And if you, I'm going to use, let's go to the stock just real quick, like CF for just a moment. Okay. Now, I want to just real quick compare and contrast. So if we said, let's say a stock trade, S stands for stock. Okay. And let's say the SP stands for a short put, okay? Now, when we do a short put, normally we're selling out of the money, okay? That means we're selling a strike below the current stock price, hence why we say we're trying to buy the stock at a discount from where the stock is now. Now, a lot of times we talk about selling a strike where the delta is, let's say, 30 to 40, okay? So in other words, I'm going to put D for delta, and I'm going to put that delta in between the 30 and 40 range. I'm just going to say 35, okay? If someone on the S side, the stock side, says, look, I'm just going to buy the shares, okay, S for shares or stock, I'm going to say, hey, how about we just buy, let's say, 35? Can anyone explain to me what is the major difference between, let's say, the stock position or shorting puts? Now, if we're talking about just the shares or the delta, they could be the same in the short term. Now, the one thing we need to know about delta on short puts, the delta does not stay constant, where the shares does, okay? But what the investor is trying to get different is they're trying to actually get exposure to two other variables. Number one is time decay, which is the only constant. And the other one is V for volatility. Now, the stock doesn't have time decay. The stock does not have volatility. The stock's now volatility of the stock can influence the stock price, but the volatility going up or down can influence the option price. So what we're trying to do is get exposure to D for delta or direction, T for time, and V for volatility. Now, in our first example, what I'm going to do is, now obviously, whether we do a stock trade or we do a cash secured put, we're thinking that the price might go up, right? Not a surprise. They're bullish strategies. Now, in this case, what we're going to try to do is, I want to kind of get a real sense of how these options really work in terms of pricing. So I want to kind of walk through what would be like 4 kind of typical trades and when we're selling puts. And if we don't know these, this is probably why we're not comfortable with it. Well, so I'm going to type in CF. Now, CF is a fertilizer stock. And first off, what I'm going to do here is, in this case, is clearly we want to make sure the shares of the stock has an average volume over 1 million. Okay. Why? Because that actually gives us a greater chance that the options, if they have them, that they might be more liquid. Now, in the market where the VIX is higher, the spreads on many options have also been wider. So we want to be attentive to that. Okay. Now, remember when I said when we go to the put side, we're going to go to a strike that has a delta of 30 to 40. That delta of 30 to 40 is telling us 2 things. Statistical odds of the stock being below the strike by a penny, okay, as of right now. And also, it's the conversion of if the stock goes up or down $1, how much does the option move by? You can almost think of it like a conversion rate, okay? If I give you 1 stock move, how much does the option move by? Well, stock goes up $1, the option is going to move by 35 cents approximately. Remember, though, with the options, that's not the only variable that can influence the option price. We just said that. Time and volatility. Don't never forget. Now, what I want to do is I want to go up to this column heading right here. And what we're going to do is we're going to go down to where it says option theoreticals and Greeks. And we're going to go over to where it says Theo price. Okay. Now, if we were to look at this, okay, I'm going to imagine that if we sold the put right now, the bid is 660. But let's say if we got something maybe a little bit more in the middle, let's say 680. Okay. Now, I want to kind of show you something for just a second that kind of shows some of the price movement. Now, notice when we change that, hit the column, go down to option theoreticals and Greeks, and then just go down to, let's say, where's it? Theo price. There it is. Okay. Now, what does that do? Well, right above where it says strikes, you're going to see that there's a drop down right there, and I'm going to click on that. Okay. Now, when I click on that, it's going to tell us the date, the stock price adjust. This is not volume. That's volume adjust. Okay. Now, what I want to first show here is we're going to kind of play through some scenarios that every investor should know. Okay. So the first thing what I want to do is here is I'm going to right click on that 130, right click, and I'm going to go to where it says sell custom. And what I'm going to do in this case is I'm going to say with stop. Okay. Now, in this case, what I'm going to really do is this is how we would probably say is the most normal. Okay. And this is just going to kind of be a stepping stone for us. So let's say example given that we decided that we're going to try to sell the option for about 680. And by the way, the mid is showing 690. So I'm going to try to push to the 690. Now, what I'm going to do is, number 1 is sell the put. The number 2 is, can we try to set a buyback order? Remember, stepping stone, right? If the goal was 50% in the first 10 trading days, well, 50% of 690 would be how much? Well, it would be $3.45. That's not going to be a stop. That is going to be a limit order, because that is the limit of what you're willing to buy it back for at the most. Hence the word limit. So we're trying to sell it at $690, but we're trying to buy it back, in this case, at $345. Now, I want you to pay attention to when we move around the price. It also then shows us what would the expected CF price need to be at. Okay, well, the stock price, what would we need the stock to probably be at? 147.44. If the stock is at 147.44, the option price, just by the calculator, would probably be at 345. So what we need to first understand is, if the stock price goes up, the option price goes where? The option price goes where? Now, the comment from Pappy says, why short put versus short put vertical? Answer, you're trying to have a higher delta or a higher, more bullish position. You're also trying to get more exposure to time decay and volatility. Okay? Now, answer that question. If the stock price goes up, the put price goes where? Fill in the blank. Where's it go? Yeah, down. Okay? That's the hardest thing for us to understand. Stock price goes up, the put price goes down. Okay? Now, we're assuming that volatility stays flat, but let's just go with that for just a second. Now, the other thing that we need to understand, and this is really the reason why it's stock versus short put. One of the most interesting things is, if you're a stock trader and you kind of have volatility in the marketplace, if your stock doesn't move to the upside, you don't typically make anything. Maybe outside the dividend, if they pay a dividend. Now, what I want you to do is, I want everyone to fixate their eyes on that 715. If we fast forward, let's say, just in time, to the 8th, to the 9th, to the 10th, 11th, 12th, 13th, watch what that Theo price is doing, right? That time decay, it's just chewing away, okay, at that option price. And this is, now, I don't know about you, I just want time to go by, okay? I just want time to go by closer to expiration. I know. It's just, when people say, how you do it, I always, in my mind, I'm like, I just want time to go by. Okay, I'll just leave it at that. Okay, now here's the deal. If time goes by, we know that the effects of the Theo price, it's eroding the option price. That time decay pushing down. So in other words, as we come closer and closer to expiration, the option is not priced at the same level. It declines in value because the time goes by. You could kind of think about this as if you rented a house, let's say in France, for 30 days, they're going to give you a price, maybe 1,500 euros. But if you said, well, I would like to stay here 2 weeks. Well, if you're going to stay there 2 weeks, what's the price in euros? And they say, well, 800 euros. Okay. Well, why is it less? Less time. Okay. Same idea. Now, if we actually said, well, what does volatility do? Well, let's say if volatility actually drops, okay, if we go down 5%, watch that 359. If I say volatility drops, it actually also pushes down the price. If it goes down 10%, it pushes down the price. If it goes down 15%, it pushes down the price. But think about this like I have teenage drivers, okay? Teenage drivers. You know where this is going to go. If they view them to be more volatile, which they have proven to be right, okay? If I add 5%, it goes up. If I add 10%, more volatility, higher premium, okay? And if we actually looked at this, let's say 15%, oh my gosh, it's really going up. Now, I'm showing you this to help you understand. We said that if the stock goes up, the put price goes down, and vice versa. Now I'm also showing the effects of time decay, right? Time is only one-sided. You just decay. And the other effect of that is, where does the volatility go? Okay? And how does it move the option price? So step one of the 4 trades here is, number one is, if we sell the put, and we try to buy it back at 50% of what we sold it for, we could actually see the expected price, and this is a limit order GTC. So trade number one, we're going to sell the put on CF. Okay, we're going to try to buy it back at 345. And this means that if we're at the post office, the grocery store, or walking the dog, it's going to try to buy that option back at 345. Now, this is not both sides. This is selling and just buying it back. Okay. Now, that's the first of four. We have to know that. Okay. Now, notice if we sell the put, 65 cents. If we buy it back, 65 cents per contract. Notice also the buying power. How much money we need to set aside in the margin account to do the trade. Okay. Send the order. Now, if I went back and said, okay, let's take the next step. Now, what I want to do is I want to go back to a small company we've never heard of before called Dell. Now, many of you know they make great computers. Well, you decide, okay? Now, what I'm going to do in this example is we're going to take that next step. We're going to try to sell the put. Now, what I'm going to do is I'm going to go down to the 165, okay? Right-click at the 165, bid. We're going to go down to sell custom, and we're going to go with OCO bracket. Okay, now, again, just baby step with me. We're going to take the same thing. Now, what's the mid price? Well, the mid price is showing 770. Okay, the first goal is, can we actually buy that back for 50% less than what we sold it for? Okay, well, if we sell it at 770, now, by the way, where'd you get the 770? Well, when I typed in that number right there, 770 is kind of just in the middle, okay? Now, what you're now going to see is if I make this, I'm going to make these all GTCs, okay? And there it is. Now, what you're now going to notice is if I look at that right now, the price is moving on us. The mid is showing us 785, and we'll try to take it, okay? Doesn't mean it's going to fail, but we're going to sure try 785. Now, if that goes to 785, what is half of 785? Check my math. I think it's like 390. Are we good? Now, I can't go 392 and 50 cents. I'm going to get as close as I can. Okay? Now, so this is, now remember, if the put, if that, we said this before, right? If the stock goes up, watch that right there. That means the put price goes down. So if we sell the put, what do we want the stock to do? Of course we want it to go up. Now, the second way that trade might work is if that trade if the stock just goes sideways and we burn time. Now, by the way, how much time would you have to burn? So here we are on, let's say, the 7th. If we fast forward out a week in time and it did nothing, the stock did nothing, well, it'd be down to 671. Does the calculation for us. If we go out to, let's say, the 24th, well, it would be at 497. If we go out to the end of end of April, it's down to 375. So if 3 weeks goes by, 50% of that option has been eroded, assuming that volatility has stayed the same. Now, let's talk about this, because this is really the big part. When we talk about cash secured puts and trading them, we kind of want to know, like, well, how would you exit the trade if it went against us? Now, in a lot of our trades, we show selling puts. Now, remember, I want to go back to the question by Pappy, okay? Why cash secured puts? Well, if you compare the differences between a short put vertical compared to a cash secured put, the cash secured put has a higher delta. Well, why would you want to do that? You want to have more exposure to the trend. If you look at the cash secured put compared to the short put vertical, higher time decay on the cash secured put. And then we also talked about volatility between those two. Which one has a higher sensitivity to changes in volatility? It's the cash secured put. Okay, so that's why. Now, the biggest actually thing is when we also take a look at this. Now, there's two ways we could do this. I'm going to show you the first way. I'm going to show you the way that some people might like. Now, this exit, we're going to make the exit of this conditional upon the stock going down. So, in other words, we're going to, on that where it says stop, we're going to change it stop to market. we're going to change day to GTC. We're going to go to the chart and say, hey, tell me where we see an area of support. Where would you say, I don't want to do a short put anymore? Now think to yourself, it's a bullish trade. So if the chart technically is starting to break down, where would you say that technical breakdown is happening? Where's the support level? Now, here's the deal. Let me ask you a question. At what point on this chart would you say, hey, the trend is not going the way that I thought it was going to do? That's a question. Now, if we kind of speculated where people might say, hey, if we get down below 170 where the moving average is, that's going the wrong way. If we actually get down below where we actually had the higher low candle, 166.5, that's going the wrong way. So you're kind of looking at the chart, identifying support and saying, look, if we go down below those areas by 1 to 2%, I don't really want to be in a short put. Why? Well, because you're obligated to buy the shares at the strike price. Why? You're not trying to buy a stock that's in a downward trend. Why? Because you're not trying to actually get into something where the volatility might explode higher. Okay? What might cause that? The price declining. Now, that's not the only way, but that's probably the major way. Now, if we look at this, what we're going to do is we're going to go over here to the right-hand side. Now, someone's going to say, well, I didn't see what you did. Remember on that third row there, market. We're going to make the exit conditional upon the stock breaching support. If you think in your lifetime, how many times you're probably going to use this? It's like maybe a lot. Now, if you said, James, I'm a stock investor, and what might be the most applicable strategy to tippy-toe over the bridge into the option land strategies is probably cash secured puts. Now, cash secured puts could just be sold to put and you're going to wait to the expiration to see what happens. Okay? In other words, I view that as like you're doing cash secured puts as a potential investment. Second, cash secured puts as a trade. That's what we're talking about. Now, we're going to click on that gear right there. Now, if I click on that gear, here's the box. We're going to say symbol, Dell. Right below where it says method, we're going to click right below that. It defaults to mark. Now, this is where we're going to say, look, if the price gets at or equal to, and I'm going to put a price number like 165, okay? Now, this confuses the living tar out of people, okay? What does this say? Dell, mark, what is that? I know that's equal, but so if you get confused, double check, okay? And down here it says, if the mark price of the security is less or equal to 165. So in other words, it's pointing, that little sideways V is pointing to 165. So that's actually saying Dell is below or equal to 165. Now, let's kind of take a quick peek at that. The $500 the question is, well, approximately what would the option price be? I thought you were never going to ask, but let's hit it. Now, let's say in a week from now, that let's say the stock falls down to 165. Now, well, where's the stock now? It's at 174. It's also showing us that the stock didn't move. It's at 174. So we could say, look, if we went down about $9 or so, minus $9, have to do a little bit more, about 971. If we get down to that 165 threshold, what would the option price be theoretically, assuming the volatility goes nowhere? So all this is doing is taking out time. It's saying the stock goes down. It's being affected by three of those variables, and it's saying that option price theoretically could be right around 1065. Now, if we sold the option for 785 now, and the stock goes down, we talked about that, 971, and let's say a week goes by. Why does that matter? Time, everyone say time decay. Time decay. And what you're now going to notice is if you take a peek of this, the loss theoretically would be the difference between those two plus the commission for selling and buying the put option contract back. How much is that? It's about $2.70. So we would be down about $2.70 or $270 per contract plus the commission. Now, the longer it takes for the stock to decline to that point, the better. Let me show that again. I want to make sure, is everyone paying attention? Do you realize most people don't pay attention these days? Do you realize that? You ever ask someone a question and it's like they're not even like listening? You do not want to not be listening right now. The longer it takes to go down to that price point, the better. Wow. Okay. Now watch that number, 1054. If I say that it took 2 weeks to go down there, it's not 1054, it's 929. So the loss is not severe. In other words, the time decay counterbalanced the price loss. Okay. Now, what if it took 3 weeks to get down there? Oh, please. Okay. Well, if it took 3 weeks to get down there and the stock finally dropped, it's not as severe. Did the trade work or lose? It pretty much broke even, but the time decay offset that loss. Okay. It counterbalanced. Now, the biggest thing is, James, that's a good part. But what's the bad part? Oh, you know it's coming. You know it's coming. It's coming right down the pipe. Well, if all of a sudden that stock, oh, this is going to hurt my feelings when I say this. If the stock drops quickly like tomorrow, oh, it could hurt even more. Because the time decay is not offsetting some of that price decline that's pushing up the option price. So stock down, price, option price, in other words, up. Inverse effect, right? Stock down, option price up. We're talking about the puts. So if, let's say, tomorrow the stock actually goes down 971, that option price 1128. And the loss potentially, theoretically, is the difference between what you sold it for and what we're showing there. Does that make sense? Now, Pappy actually says, if it goes down fast, would that not increase vol? Well, let's add that point. Pappy, you're only allowed one good question a session. I'm just joking with you, Pappy. Now here it is. Let's say all of a sudden volatility goes up too. I mean, this is the root of the root. You get price to go down quickly, and it does it in a short amount of period of time, and just add salt to the wound. It's just literally the volatility says, look, I'm going to hit you with 5% volatility. Well, what does it do? It pushes up that price even more. The higher, and as the volatility goes up, I call this the triple whammy. It does it in a short time frame. The stock price actually goes down, and the volatility actually goes up. And these are all three factors that go against you as the seller of the put. Okay? So now, by the way, could you do the opposite? Could the stock in the short term go up? Yes. Could it do it in a short time frame? Yes. Could volatility instead go up 5%? Could it go down 5%? Yes. But you need to understand both sides of that. Okay? But as a cash secured put trader, this is the worst scenario when all three variables literally go against us. Okay? Now, so what we actually did in this case, so when you talk about the four, I mean, these are things you must know. If you say, I don't know these, that's why you're not confident in it. Okay? So what we're doing is we're selling the put. We're buying the put back at 50% of whatever we sell it for. Second there, the buyback, is we're saying if we go down at or below 165, buy the put back. Okay? Now, notice the commission. We have a commission to, in this case, sell the put, 65 cents. The buyback is not going to be at both. Okay? It's one or the other. Hence, one cancels other. We're going to go back and actually say send that, and there it goes. Now, I want to go back to real quick, just kind of the third one, which is really saying, now, how many of you have ever said to yourself, geez, I would really like to buy, I really like to sell the put if the stock were to break to the upside. You ever thought that? Now, we talk about that with buy stops on stocks quite a bit. We say if the stock goes at or above a certain price, enter the stock if it gets to this price or higher. In the world of stocks, we call that buy stop or buy stop limit. Buy it if it gets to this price or higher, but there's a limit on what we're going to try to buy it back for. Yeah. The third of the four entries that we need to know is how would you set that up? We know that with stocks, but how would I do that with a cash secured put? Well, number one is define the resistance. What's that point where you would say, I'd like to enter in a bullish strategy if the price went at or above resistance? So number one, you got to define the resistance. Typically, when we look at resistance, we're going to go back, let's say 2-3 weeks. Most of the touches in 2-3 weeks have been right around the 306. Second question we got to ask ourselves is, how far above that line would you say then enter the position? Now, for this example, I'm going to use the 1% rule methodology. If we get 1% above that area, which is about $3, so number one, if the resistance is 306, second question we said, well, how far above that would you want to try to get in? Well, I'll tack on 1%, and if we go to about 309, enter the position. Okay? Now, how do you do that? Now, think about how many trades have been missed because people are not clear on the order types. I mean, I tossed and turned last night thinking about this. I think a lot of times people struggle with order types. And so I can sleep better tonight, I just want to make sure we're crystal clear. Now, what I'm going to do is going to go to the trade tab. And I got AXP here. Number one is, in this case, is I'm going to try to sell. Now, here's the thing that we need to think about a little bit. If we sold the 290 now, that's the delta that is showing 32. Now, here's the double jeopardy question, okay? Now, that's the delta now. But if the stock went up to 309, would that delta stay the same, become bigger, or would it become smaller? My gosh, if you get this, Barb might hand out virtual treats. Okay, now, so the question is, if the stock goes up, does the delta stay the same? Does it get bigger, or does it get less? The answer to that question is it gets smaller. Because if the stock goes up, why? Think about it. Well, there's lesser chance of the stock being below the strike price. That's why. So you might say, well, James, I like to sell the 300 because this is showing a 42 now. But if the stock goes up, let's say $1, we could do the math in our dadgum head, okay? If the stock went up, let's say, if the delta was now 42, and we want the stock to go up about $5, well, we could just say, look, for every $1 the stock goes up, the change in the delta is gamma. It's going to be about 1. So if we wait for this stock to go up to about 309, that means that this is what the delta is now. But by the time this trade fills, if it does, it's going to probably be right around about a 37, 38 delta. Delta is saying the first dollar move. That gamma is saying if the stock goes up or down $1, what is the change in the delta? Well, if the stock goes up or down $1, that gamma is showing 1 or 1%. Okay? And so if the stock goes up, let's say $4 or $5, that delta should shrink by about 4 or 5. And that means that delta would be at 37. So think that through. So now, by the way, if you just sold this, you're not quite thinking through if the stock goes to the up price where we're thinking about what is the delta going to be? Is that really the strike that you want to sell? So in this case, what I'm going to do is I'm going to click on that 1235. I'm going to move it to the price of that 1260. We're going to change this to the limit, not limit. Boo. We're going to go to market. Okay? We're going to go dated GTC. And what we're going to say, look, AXP, American Express. If you go to 309, then enter the position. So now if I click right down below symbol, method, mark, we're going to turn that sideways V around and say, let's turn it to the stock price. Okay? If that stock price gets at or equal to, and we're going to type in the price of 309. Okay? Now, by the way, could you figure out approximately what that price is? Yes, that's why we did Theo price. And if we look at this, we're saying, look, if AXP gets at or above 309, we could read this now. Mark price of the security is greater or equal to 309. Now, remember, we actually did that. We said if the stock price goes up, where does the option price go typically? Assuming that volatility doesn't move. The option price should go down, okay? Typically. We're going to save that, confirm, and send. So the third order type, okay, this is really saying if it breaks out to the upside, this is a trigger to sell the put if the stock gets to that price or higher, okay? Now, the last one in a 2-minute example. But wonder if you said, James, I want to do it if it goes to this price or lower. All right. Now, let's kind of take this. If we said example given, the fourth of 4. If I said, hey, I want to try to sell the put if the stock were going to go down a little bit. Well, if this stock, if I said, look, I'm trying to sell this put maybe a little bit closer to the moving average. Let's say example given 208. Well, if I did, we're just going to flip what we just did. Now, I'm going to choose the 205. You could walk through what that delta would be if the stock fell down $2. And we could just say it right now. For every dollar the stock goes up or down, the delta changes by about 1. Okay? Stock goes down about 2. That means that the delta would be probably what? 41. If you don't like that and say, I want to keep that in the range of delta 30 and 40, we would probably sell the 200. Now, here's where probably a lot of people say, I like this order. I'm going to click on that 200. Just like we did before, we're going to come over here to where it says limit, market, day, GTC. Now, instead of saying at or above, we're going to say at or below. Okay? Now, by the way, as a homework assignment, you should be able to say, look, you could sell a put with a buyback. You should be able to actually say, I could sell a put with an OCO order. I could sell a put if it breaks at or above, or I could sell a put if it goes at or below. This is your homework. If you don't know these 4, go back and watch this again. Now, what I'm going to do is if I go, let's say, the Amazon method, we're going to turn that sideways V to the stock price. And we're going to say, look, we want the stock price to be at or below 200. Okay? Now, in your world, how many times have you said, I like to enter in a bullish position if it went to this price or less? You could answer that question. Okay? We know it's probably pretty high. Again, if you're concerned, if you're like, what is it telling me? We're saying this price or less. Okay? Less or equal to. There it is. Save the order. Confirm send. This is conditional. What happens if the stock never comes down to that price? It doesn't fill. You need the price to come down. We talked about the effects of stock price, time, and volatility on the option price. We talked about the 4 order types. As a homework assignment, go in your paper money account and practice these 4. Do not assume that you watch me do it and I know how to do it. Go out and yourself practice it. In the current market, there's examples of cash secured puts that you can practice. Work that paper money account and make sure that you can do these 4. And also ask yourself, is this something you would consider for yourself? Now, also quick reminder that this class has been recorded. And for example, you could go right to the Trader Talks Schwab coaching webcast that is right there. So if you go into YouTube and search Trader Talk Schwab coaching webcast, it's been recorded. If you have not subscribed, subscribe. Coming up next, Ben Watson will actually teach our next session. Coming up later this afternoon, Barbara will actually teach Getting Started with Technical Analysis. So join us throughout the day as well. I want to say thank you so much for your time, and kind of an opportunity to together practice cash secured puts as a trading strategy using 4 order types that every investor should know. And also remember, with what we talked about is done for example, illustrative purposes only. And remember that all investing involves risk. And this has been the session for Investor Master Series. Thanks so much. Take care. Bye-bye.